This content is for educational purposes only and does not constitute financial advice. Trading involves significant risk. Always do your own research and consult a qualified financial advisor before making any investment decisions. Right now, while you are watching this video, the biggest institutions on Wall Street are either quietly building massive positions in AI stocks or quietly getting out, and they are doing it in a way that does not show up on the price chart at first glance. The stock might look completely flat, just chopping sideways for days or weeks. Nothing exciting happening. Most traders scroll right past it. But underneath that boring sideways action, billions of dollars are changing hands, and the volume bars are leaving footprints, literal footprints, that tell you exactly what the smart money is doing. These footprints are called accumulation and distribution. Accumulation is when institutions are quietly buying. Distribution is when they are quietly selling. And if you learn to read these footprints, you will start seeing the biggest moves before they happen, not after, before. You will see a stock sitting in a boring range and know that underneath the surface, smart money is loading up and a breakout is coming. Or, you will see a stock holding at highs and realize that the big players are distributing, selling into every rally, and a breakdown is around the corner. This is one of the most powerful edges in all of technical analysis, and today, you are going to learn exactly how it works. Let us start with accumulation. Accumulation is the process by which large institutions, hedge funds, mutual funds, pension funds, the big players, build a large position in a stock without driving the price up dramatically. Why do they need to be quiet about it? Because if a fund wants to buy 10 million shares of a stock, they cannot just place one giant order. That would spike the price immediately. They would end up buying most of their shares at inflated prices, which defeats the whole purpose. So instead, they accumulate slowly. They buy on the dips. They buy during periods of fear and uncertainty, when retail traders are selling. They spread their buying over days, weeks, sometimes months. And during this entire time, the stock price goes sideways. It looks boring. It looks like nothing is happening. But volume tells a different story. During accumulation, the UP days within the range have noticeably higher volume than the down days. Think about why. On the green days, the institution is buying. That adds volume. On the red days, only retail traders and weak hands are selling, so volume is light. It creates this asymmetry in the volume bars that you can see clear as day once you know what to look for. The candles say nothing is happening. The volume says everything is happening. This is especially relevant in the AI and semiconductor space right now. Stocks like NVIDIA, AMD, and Broadcom go through regular accumulation phases after corrections. The stock pulls back 20 or 30%. The media declares the AI trade is over, and then, the smart money starts quietly buying. Every day, in the range, the green volume bars are taller than the red ones. And a few weeks later, the stock breaks out to new highs and everyone acts surprised. But if you were watching the volume, you saw it coming. Now let us look at the other side. Distribution. Distribution is the exact opposite of accumulation. It is the process by which large institutions exit a position without crashing the price. They sell into strength. Every time the stock rallies within a range, they are selling shares. Every time retail traders get excited about a new push higher, the smart money is using that liquidity to dump their shares. And once again, the price action looks deceptively calm. The stock is near its highs, chopping sideways, maybe making a few small new highs. It looks bullish. It feels like the trend is just consolidating before the next leg up. But the volume tells you the truth. During distribution, the down days within the range have significantly higher volume than the UP days. On the red candles, the institutions are selling in size. On the green candles, there is no institutional conviction, just retail buying on light volume. This asymmetry is the distribution footprint, and once you see it, you know the smart money is heading for the exits. The tricky part is that distribution can take weeks or even months. The stock might even make marginal new highs during distribution. That is by design. The institutions want you to think the trend is healthy. They need buyers to sell into. Every hopeful retail trader who buys the dip during distribution is absorbing the shares that the smart money is selling. It is a quiet transfer of ownership from strong hands to weak hands. And when the distribution is complete, when the smart money has sold everything it wants to sell, that is when the breakdown happens. Fast, violent, and seemingly out of nowhere. But it was not out of nowhere. The volume told you it was coming. Now here is where it gets really interesting, and where most traders get destroyed. There is a step between accumulation and the big move that most people never talk about. It is called manipulation, and it is the most devious part of the entire cycle. Traders call this the AMD cycle. A for accumulation, M for manipulation, D for distribution. Here is how it works. After the smart money finishes accumulating, after they have quietly built their position over days or weeks in a sideways range, they do not just let the stock break out cleanly. That would be too easy. Instead, they engineer a false breakdown. The stock drops below the bottom of the accumulation range, taking out every stop loss sitting underneath that support level. Retail traders who bought in the range see their stops get hit and they get shaken out. New short sellers pile in, thinking the stock is breaking down. The fear spikes. It looks like the stock is about to crash. And that is exactly the moment the smart money steps in and buys everything. The false breakdown, the spring, the manipulation event serves two purposes. First, it creates a flood of selling from stopped-out traders and new shorts. That selling gives the smart money even more supply to buy at cheap prices. Second, it clears out the weak hands. The only people left holding the stock after the manipulation are the institutions who accumulated and are not going to sell. Once the manipulation is complete, the stock rockets higher. It breaks back above the range, and now all those new short sellers are trapped. They have to buy to cover their shorts, which adds fuel to the rally. The markup phase begins, and it is powerful because there is almost no overhead supply left. Everyone who was going to sell already got shaken out. This is why the biggest, fastest moves often start with a fake breakdown. It is not random. It is by design. The AMD cycle is how the market really works, and once you see it, you cannot unsee it. Every AI stock you watch goes through this pattern. NVIDIA does it. AMD does it. The entire semiconductor sector does it. The manipulation phase is the trap that separates the smart money from the crowd. Let me give you the specific checklist for identifying accumulation in real time. Number 1. The stock must be in a range after a meaningful decline or pullback. Accumulation does not happen at all-time highs. It happens after the stock has already pulled back and the crowd has given up on it. Number 2. The range should show higher volume on green days and lower volume on red days. This is the core signal. Pull up the volume bars and compare. If the green bars are consistently taller, institutions are buying on the up days. Number 3. Watch for springs or false breakdowns. This is a classic Wyckoff event. The stock briefly dips below the bottom of the range, triggering stop losses and scaring out the weak holders, and then immediately reverses back into the range. The spring happens on relatively light volume, which tells you it was not real selling. It was a shakeout, a trap designed to create panic and allow the smart money to buy even more shares at cheaper prices. Number 4. The breakout above the range should happen on a surge of volume. This is the confirmation that accumulation is complete and the markup phase is beginning. If the stock breaks above the range on light volume, be cautious. That might be a false breakout. But if it breaks out on 2 to 3 times average volume, the institutions are done accumulating and they are letting the stock run. When you see all 4 of these signals together, you are looking at a textbook accumulation setup. Quick pause. If this is clicking for you and you are starting to see the market differently, do me a favor. Hit that like button and subscribe. Tap the bell. It costs you nothing and it helps me keep making this free content. And if you are working on your career alongside your trading, check out Resume Zenith for clean professional resumes that actually get callbacks. Link in the description. Alright, let us keep going. Now here is the checklist for spotting distribution. Number 1. The stock is in a range after a sustained rally, near the highs. Distribution happens at the top, not the bottom. Number 2. The range shows higher volume on red days and lower volume on green days. The opposite of accumulation. The institutions are selling on the down days, and the rallies within the range are weak and unconvincing. Number 3. Watch for upthrusts or false breakouts. The stock briefly pushes above the top of the range, everyone gets excited, and then it immediately falls back. The upthrust happens on relatively light volume, telling you it was not a real breakout. It was a trap, designed to lure in late buyers who the smart money then sells to. Number 4. The breakdown below the range should happen on a surge of volume. This confirms the distribution is complete and the markdown phase is beginning. Here is a practical tip that will save you a lot of pain in AI stocks specifically. When a semiconductor stock hits new highs after a major rally and then starts to chop sideways for 2 or 3 weeks, most people assume it is just consolidating before the next leg up, and sometimes it is. But check the volume. If the red days within that range consistently have higher volume than the green days, you are looking at distribution, not consolidation. The smart money is not resting, they are leaving, and you should too. Let me warn you about the biggest mistakes people make with accumulation and distribution analysis. Mistake number 1. Confusing consolidation with accumulation or distribution. Not every sideways range is one or the other. Some ranges are just the market taking a breather. The key is the volume asymmetry. If up-day volume and down-day volume are roughly equal, it is just consolidation. It is neutral. Only when there is a clear asymmetry do you have evidence of accumulation or distribution. Mistake number 2, expecting it to happen quickly. Accumulation and distribution take time. Big institutions are moving massive amounts of capital. They cannot do it in 3 days. Expect these phases to last 2 to 8 weeks at minimum, sometimes longer for very large cap stocks. If you try to call it after just a few days of data, you will be wrong more often than right. Mistake number 3, ignoring the context. Accumulation is most significant after a meaningful decline. Distribution is most significant after a meaningful rally. If a stock has been flat for 6 months with no prior trend, any sideways action is more likely just noise, not smart money activity. Mistake number 4, acting before the breakout or breakdown. The accumulation or distribution pattern is the setup, not the signal. The signal is the breakout on heavy volume or the breakdown on heavy volume. Buying in the middle of the range because you think it might be accumulation is just guessing. Wait for the confirmation. The breakout will come if the accumulation is real. Your job is to be ready for it, not to front run it. Let me walk you through how to apply everything we have learned to the AI and semiconductor stocks you are probably watching right now. Start with the big picture. Where is the stock in the AMD cycle? Has it recently pulled back significantly? Then look for accumulation signs. Has it recently rallied to new highs and is now chopping sideways? Then look for distribution signs. Is it trending strongly with healthy volume? Then you are in the markup or markdown phase. Next, zoom into the range. Compare the volume on the green days versus the red days. You do not need any fancy indicators for this. Just look at the bars. Are the green bars consistently taller? Accumulation. Are the red bars consistently taller? Distribution. Are they roughly equal? Neutral consolidation. Then watch for the events. Springs and false breakdowns suggest accumulation is nearing completion. Upthrusts and false breakouts suggest distribution is nearing completion. And finally, wait for the confirmation. The breakout or breakdown on heavy volume is your entry trigger. This framework gives you a massive edge because most retail traders do not look at volume at all. They see a stock chopping sideways and they move on. They do not realize that the most important action happens during these boring periods, when the smart money is positioning for the next major move. The sideways action is the action. You just need to know how to read it. Homework time. Here is your assignment, and this one is going to be really powerful. First, pull up the TradingView chart for 3 AI or semiconductor stocks. I recommend NVIDIA, AMD, and SMH, the semiconductor ETF, but use whatever you are watching. Second, for each stock, identify the last sideways range that occurred after a significant move, either up or down. Third, within each range, compare the volume on the green candles versus the red candles, which were consistently taller. Fourth, based on that comparison, label each range as accumulation, distribution, or neutral. Fifth, look at what happened after the range. Did the stock break out or break down? Did it happen on heavy volume? Was your label correct? This exercise will train your eyes to see what 95% of traders completely miss. For extra credit, track the current price action on one stock going forward. Each day, note whether the volume was higher on the up move or the down move. Build a running tally. Over a week or two, the pattern will become crystal clear, and you will know what the smart money is doing before the crowd has any idea. Bonus question. Can you find a manipulation event, a false breakdown that shook everyone out right before the real move started? Once you spot your first one, you will start seeing them everywhere. Your complete AMD Cycle checklist is in the free cheat sheet at candlelogictrading.com. And now you understand the AMD Cycle, the real playbook that the smart money uses to move markets. Accumulation is the quiet buildup. Manipulation is the trap that shakes out the weak hands. Distribution is the quiet exit at the top. And volume is the trail they cannot hide through any of it. Every time a stock goes sideways, the volume bars are telling you whether the big players are building positions, engineering a shakeout, or dumping their shares. Read those bars, and you will see the next major move coming before it happens. In the next and final lesson of Phase 2, we bring everything together at the most important locations on the chart, the key levels. Support and resistance zones where volume, price, and the patterns we have studied all converge to create the highest probability trade setups. That is Lesson 15, and it is the capstone of everything we have built in this volume series. Subscribe and hit the bell so you do not miss it. New lessons every Sunday, Tuesday, and Thursday. If this helped you, smash that like button and share it with someone who is still trying to trade without volume. Go practice, protect your capital, and I will see you in the next one. This content is for educational purposes only and does not constitute financial advice. Trading involves significant risk. Always do your own research and consult a qualified financial advisor before making any investment decisions.